What exactly is goodwill? In simple terms, goodwill is an intangible asset that arises when one company acquires another for a price higher than the fair market value of its net identifiable assets. It's like a premium that you're willing to pay for the reputation, customer loyalty, brand strength, or other non-tangible factors of a company. Think about it this way: Company A buys Company B for 10 million, but when you look at the fair value of all of Company B's assets and subtract its liabilities, they're only worth 8 million. That 2 million difference, that's goodwill. Let's break this down visually. Company B's total assets, including things like inventory, property, and equipment, are worth 12 million. Now, let's say their liabilities, like debt, come to 4 million. The fair value of the net identifiable assets is 12 million minus 4 million, which gives us 8 million. But Company A paid 10 million, so the 2 million extra is goodwill. Now, how does this work in the real world? Well, goodwill isn't something you can touch like inventory or equipment. It's tied to intangible aspects, like the value of a brand, customer relationships, or intellectual property. For example, when a big company like Coca-Cola buys a smaller beverage company, the goodwill could reflect the brand recognition and customer loyalty that the smaller company has built. These are assets that don't appear on the balance sheet, but can still have massive value. Goodwill also has a long-term effect. Once it's recorded on the balance sheet, it stays there until the value changes, either through impairment or other factors that could affect its worth. Alright, now let's get into how to calculate goodwill step by step. 1. Determine purchase price. The first step is to know the total purchase price of the acquisition. For example, let's say Company A bought Company B for 10 million. 2. Identify the fair market value of assets and liabilities. Next, you'll need to calculate the fair market value of the company's assets and liabilities. Let's say Company B's assets are worth 12 million and their liabilities are 4 million. That means their net identifiable assets are 12 million minus 4 million, which equals 8 million. 3. Calculate goodwill. Now, subtract the net identifiable assets from the purchase price. In this case, it's 10 million, purchase price, minus 8 million, net assets, giving you 2 million in goodwill. And that's it! You've calculated goodwill. But here's a pro tip: goodwill is subject to an annual impairment test, which means if the value of the acquired company drops, you may need to write down the value of goodwill. Impairment happens when the carrying amount of goodwill exceeds its fair value. If a company's goodwill is found to be impaired, it must be written down as an expense, which can affect earnings. For instance, if goodwill impairment is recognized, it shows up as an expense on the income statement, reducing the net income of the company. So, to sum it up, goodwill is the extra value paid over a company's net identifiable assets. It reflects intangible assets like brand strength or customer loyalty, and it's calculated by subtracting the fair market value of assets and liabilities from the purchase price. Thanks for tuning in to learn about goodwill in accounting. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more finance and accounting breakdowns. And if you have any questions about goodwill or any other financial topics, drop them in the comments below.